What's happening, y'all? Just like I said in my last video, the war shook up the stock market a little bit. I added a couple plays, so I'm gonna go over the plays that I added to my portfolio. I'm gonna go into a little bit of education on how to adjust your portfolios during war and so on and so forth. So far, for a month's period, I'm up over the stock market. I'm up 4.97%. The stock market is up 1.13%. Over this past week, I'm up 0.76%. The stock market is down 0.15%. So I'm beat the stock market last month. But I want y'all to think about this too. So when you diversify your portfolio, when the market is going down, you shouldn't expect to beat the stock market every time the stock market is going down. The stock market goes up most of the time. So some of the stocks that you buy when the stock market is going down is really just to soften the blow, right? Because remember, I always tell y'all, your first position, your biggest position, your tech play, your front runner, that is going to be the biggest play. So that one will grow the fastest over a long period of time. But when the stock market is going down, they go down the hardest. So diversifying your portfolio is not necessarily saying that even though I beat the market this past week, when the stock market is going down, you're not guaranteed to beat the market when it's going down. You just want to soften the blow of your portfolio going down, because the biggest position in your portfolio will go down the hardest. But this week, I still beat the stock market. So as y'all can see, I added 0.76 shares of ExxonMobil, and I got 2 shares of gold. I know I told y'all I was gonna add gold, but I also added ExxonMobil. Gold, of course, is a hedge against inflation. It's like the oldest money of all time. Gold and ExxonMobil are both commodities. They're gas and oil, right? So commodities are like tangible assets, gas, oil, corn, copper, stuff like that. And they particularly perform better than other companies when the stock market isn't doing good. So like I said before, these assets will soften the blow when the main position in your portfolio is going down. So as you can see last week, what carried my portfolio was gold and ExxonMobil. So gold, obviously, I showed y'all why I chose one gold ETF over the last one in my last portfolio. But this week, I want to show you why I chose ExxonMobil. So just like Apple or NVIDIA right now is the #1 stock market cap wise in the stock market, ExxonMobil at one time was the leader in the stock market. At one point, oil actually was the best mover in the stock market, but of course, technology advanced since then, and ExxonMobil is no longer the leading company in the stock market. But just because it was at some point, I like that. So that was #1. It was really between ExxonMobil and Chevron. But the reason why I like ExxonMobil over Chevron, and I'm gonna give y'all a quick comparison because each one doesn't fit for everybody. You got to decide. But out of ExxonMobil and Chevron, I chose ExxonMobil because over a longer period of time, ExxonMobil has performed better. But Chevron pays a better dividend. So if you care about if you wanted your oil play to be more a dividend-based oil play and you cared more about the dividend yield, you would go with Chevron over Exxon. But I'm still going heavy on growth, not really considering a dividend as much, or not prioritizing it as much, but more about the percentage growth in my portfolio. Over a 5-year period, ExxonMobil has outperformed the stock market. So even though it's not going to grow as fast as NVIDIA or anything like that, I chose it for my play, but it doesn't mean that Chevron is a bad move. There's other gas companies that you could pick as well that will do great. But those are kind of the two best or the 2 long-term gas plays that you could choose for your portfolio that's been stable over a long period of time and have a track record of doing pretty well. So Exxon for growth, Chevron for a dividend. But another reason why I chose oil, of course, Oil does good when the stock market is going down. There's a lot of oil used for war, but you also have seasonal rotation, right? So we're in the summer season right now, and in the summer, a lot of people are going on vacation. A lot of people are traveling. They're getting on planes. They're getting in their cars. So a lot more gas is being used during the summertime. So even though there's a war right now, even if there wasn't a war, gas would be important during the summer times when people are taking more vacation and more gas is being needed. It's just so happened that a war is going on right now during the summer season. So also consider seasonality changes when you're investing in your portfolio. You want to have something that's going to do good during the summer. You know, Amazon is going to do good during the winter. You know, December. The last quarter is really like the best quarter for the stock market. So, you know, the last quarter, your front runner, NVIDIA, all of that is definitely going to do real good. But then the summertime, you want to look at your gas companies. You want to look at travel. You know what I'm saying? I'm not a big fan of, getting Delta. I'm not a big fan of getting Delta Airlines or Spirit in my portfolio, but just to kind of get a feel of seasonality, you could pick Delta or American Airline, if you want something that's going to do good during the summer. I like to have gas in my portfolio because it's a commodity. It does good during the summertime, and it usually pay a good dividend, but I chose the one that pays lesser of a dividend, Exxon over Chevron. So far I'm up. This week I'm not adding anything else to the portfolio. I will be adding to existing positions. So the stock market probably is going to continue to go down next week. So I'm probably going to buy more of Exxon Mobil. But before I go, I want to give y'all just a little bit more education. I want to make sure every video I give you something real good to know how to assess the stock market like a professional, right? So last week I gave y'all a little bit of chart work. This week you can look at this on the chart, or you can ask ChatGPT whatever you want to do. But if you want to look, if you look at bond yields can tell you which direction you expect the stock market to go, right? So by looking at the bond yields, the higher the bond yields is the less, if the bond yields are higher, that means the stock market will come down. The bond yields are basically the yield that you get on the bonds, right? And it's a fixed rate of return. So if the bond yield is 7%, you could expect to get 7% on the bonds. So that's a safer growth. That's a safer growth investment versus when the stock market is going down, bond yields go up. So if bond yields are going higher, you can expect the stock market to go down. If you're expecting the stock market to go down, you can either invest in bonds. I don't invest in bonds myself. I prefer to invest in like gold or oil and stuff like that. But by looking at bond yields, also, like last week when I showed you, you could look at the chart, you could look at bond yields, and bond yields will tell you, okay, well, bond yields are going up. That means the stock market is going down. People are pulling their money out of the stock market and putting them into bonds to get more of a fixed rate of return versus losing money in the stock market. And then when the stock market goes back up, they pull their money out of bonds and put them back into the stock market. So by paying attention to bond yields, that could let you know how to adjust your positions like I did last week, knowing that there was a war, and by looking at the chart to adjust your position accordingly. Or you could shave off the top, sell some of your front runner assets. I don't really recommend selling stock, but some people sell stocks when the stock market is going down. They take some profits and then buy more when it's going down. You could try that, but you do have to pay capital gains tax for selling them. So if you don't want to spend no tax at all, you keep the position, you just hold it and adjust accordingly like I'm teaching y'all in this video. I'm Mike the Money Motivator, man. Y'all like and subscribe.